Hello, everyone. Um, Hi, everyone. Thank you for being here. So let me welcome you to the European Stability Mechanism on behalf of the organizing team, which is Ernest Nan and Jakob Kierkegaard, Maria Campa, Dragana Popovic, and Giovanni Callegari. I am not Pierre, I am Ermal, one of the organizing team. Pierre is right here. So these are interesting times we are living, and there is an English saying, supposedly deriving from a Chinese curse, may you live in interesting times, because interesting times are not easy. At the same time, they breed interesting thinking and interesting solutions, and that's some of that thinking that we want to do here today and tomorrow at the conference. And to kick off that thinking, I'd like to invite to the podium our managing director, Pierre Gramegna. Pierre, please.
So, ladies and gentlemen, welcome at the European Stability Mechanism. I had the opportunity to shake a few hands, especially of the speakers, and for some of you it's the first visit at the ESM, so I'm sure you will enjoy the conference because it was put together with a lot of competence and a lot of application by the team. And I think the theme was well chosen because how Europe is prepared for extreme events is a question that we all have in the back of our mind. We are co-organizing this conference with Bruegel and with SUERF. And then I looked up what SUERF means, and then they say it's the European Money and Finance Forum. So I said, that doesn't match SUERF. So I thought, I'm telling you what SUERF means. Société Universitaire Européenne de Recherche Financière. It allows me to say a few French words. So thanks to SUERF. So, is Europe prepared for an extreme crisis? What we also read into this ourselves is the ESM prepared for extreme crises and extreme risks. What you're going to explore in the next 2 days is what different types of risks we know or anticipate. So some of them are known, some of them are even unknown. Remember, COVID was really on nobody's radar. It was a pandemic that nobody had anticipated. So sometimes you even have to be prepared for the unknown. But there's lots of things that are known that we have to prepare for. Now, you probably would be disappointed if I wouldn't start in my introduction by saying that today is day 2 after the liberation of the United States. And I would like you to think for a moment just on the wording that was used. It's not a detail that it was called a liberation of the United States. I did not know that the United States wasn't free. So I think what was announced yesterday is a game changer, and I will say a few words on this. We live in a shock-prone world, and in the last 15 years, you could say we've had 4 shocks. We had the financial crisis 2009, we had COVID 2020, we had the war in Ukraine, the aggressive war of Russia in Ukraine 2022, which is still ongoing, on the European continent, on our doorstep. And now we have a different United States. Out of these 4, I would say 2 were definitely short-term shocks, the financial crisis and COVID. I would say that the war in Ukraine, hopefully, is a shock that will not be long-term, but will finish, I hope, soon, hopefully. But the change of mind of the United States, I think that's a long-term thing. So I think in the whole seminar that you're going to do today and tomorrow, it's always important to think, is the risks, the events, the extreme events that we're talking about, are they medium and long term, or they more short term? Because the answers can be different depending on that. In some cases, it's not easy to answer that question. Now, I'd like to say a few things on what happened yesterday. So, a large amount of tariff increases basically directed to the rest of the world, the first victim being China, in terms of the amount of tariffs, Europe being the second, and then many other countries. What will that produce? I will be very simplistic, and some economists, and there are very good economists in the room, and some of you will also be in the panels, might challenge part of that, but in simple words, I would say tariffs increase inflation, and tariffs reduce international trade. If inflation goes up, central banks increase interest rates, which will slow down the economy. If there's less international trade, there's less growth. So we have two effects that reduce growth. And that can be a vicious circle, one nourishing the other. Some say this is overdone, this is not what's going to happen. This is not even what the American administration has in mind. They have another purpose, they have another reason why they go on this tariff war, which can probably land into a trade war. Now, Europe will be hit more than any other region in the world for another reason, not only because the tariffs are high, but because for us, international trade represents 60% of our GDP, not counting internal trade, not counting internal trade. For the United States, this number is 25%. So their dependency on foreign trade is far lower. For China, it's more or less in between, it's around 38%. So trade has been the driving engine of growth in the last 30 years. The one thing that was continuously pushing world growth. Every time I go to the IMF, I hear that. Kristalina talks about it. Her predecessor talked about it. Christine Lagarde was always talking about it. I don't think that it is easy to challenge. So that's the economic consequences. Now, on the narrative, Liberation Day. What it really means is a departure of the United States, a unilateral departure of the United States from multilateralism. A unilateral move to walk away from treaties, from existing rules. Not only World Trade Organization, which would be the one organization to which you should refer if you have trade disputes, but we know that all international institutions are under scrutiny by the administration. We don't know what's going to come out of that. So, Liberation Day is another way of saying, make America great again, and I would add the sentence, and make the rest of the world weaker. So, I think this is an evolution that is very worrying. In one sense, we Europeans have underestimated not only what the Trump administration wanted to do, but we haven't listened carefully to what other presidents told us. I specifically think of President Obama, who already told us that Europe should do more in defense. So it's not only that this comes suddenly. I think it has been in the making, not all of it, but some of the things were in the making. And now suddenly we are confronted with many problems to solve, which seem very difficult to solve in the short term. In all this bad news, there is one good news, and that is that the competence for trade issues is an exclusive one of the European Commission. And I'm confident that this will help to have a unified response to the tariffs that have been announced. I listened carefully to what Mrs. van der Leyen said, was it this morning or yesterday evening, that Europe was ready to negotiate, which is very good. And if obviously these negotiations do not have a fruitful ending, well, we will have to retaliate. So keeping the door for negotiation open is good. And I trust the Commission will find a balanced and smart response. Now, you could ask yourself, and it's a bit my second part, what role for European institutions in general, and what role for the European Stability Mechanism in all of this? Our role is to safeguard financial stability in the euro area. And in order to do that, it is not only necessary to be able to react, it is also important to predict, to foresee what's going to happen, to anticipate. And so that's what we're continuously doing. And we have a toolkit, that's all our financial instruments, which we are regularly testing to see if they're fit for purpose. We are in the middle of such an exercise. We have done that over the last year and continue it this year. And we'll have very good discussions also in upcoming months with the Board of Governors of the ESM and with the Eurogroup on that toolkit. Looking at the instruments we have, I think it is important to realize, for those who are not specialists of the ESM, we have different types of instruments. The ones that are better known are those that have been used in the last decade when we were either supporting banks with recapitalization or supporting directly countries. These are programs that are very heavy with conditionality. We reform of macroeconomic programs of countries. And so that's what was more visible. But we also have another set of instruments called precautionary loans or precautionary guarantees that have never been used. Now, the precautionary loans are there to support countries not when they are already in dire straits, when they are losing access to financial markets, but when they are starting to feel the heat, you could say, or financial problems. And so these instruments can be used before the crisis really completely rolls out. So it is important for us to have analytical capabilities in order to anticipate the possible consequences of events, extreme events, on the financial stability of the euro area. So we need to understand the risks, we need to have the right human resources for that, and we have strengthened those financial resources. We are also working very, very actively with many of you, with different international institutions and with researchers in order to be very well aware what the latest findings are in terms of macroeconomics. We are producing discussion papers, briefs, and blogs, and I would like just to mention a few, which are also food for thought for you. Let me mention maybe one that we wrote that was dedicated to what we call insurance protection gap. But before coming to that, let me also insist on the fact that besides the geopolitical fragmentation to which I was alluding in the beginning of my introduction, we at the ESM see two megatrends that are there to stay, along with the geopolitical fragmentation. Number two is climate change, and number three is demography. Now, on climate change, you can just take a political decision that you do not care about climate change, but the issues are there to stay, and the consequences of climate change are going to hit you and hit your country. So natural catastrophes are multiplying. You see that in all parts of the world. And in fact, we have dedicated a blog to that, saying and realizing that 2/3, if not more, of damages caused by climate risks are not covered by insurance and cannot be covered by insurance because it's too costly. There's no model for doing it. So in this blog, we launch an idea, which is to say, couldn't we do something similar to what the ESM is doing for financial stability and having a kind of risk-sharing scheme, a European risk-sharing scheme that works as a backstop. Having that backstop would make more risks insurable. So I think the teams that worked on that did a real intelligent job. And I think in these times of extreme crisis, we need to come up with new types of solutions. And climate change is hitting hard, especially since 20 years or 30 years. So it's an issue that wasn't around at the time. But we see that there are lots of gaps that we have to fill in, lots of different policies we have to invent. We have also written a blog and a couple of things on the whole issue of capital markets and banking union, which is now being called investment and savings union. That was a proposal by Enrico Letta in his report, and I really like that expression a lot. I still use the other words so that I can make the link, but if you ask me, I would only use the investment and savings union's name because you understand what's at stake. It's not about capitalism and banks. It's about financing the economy, having sufficient money for investment, and for the retail products is to have people who invest in products that are good for them and good for the economy. Europe is the world champion in savings. We have 33 trillion euro of savings, which are not used in such a smart way, in a very conservative way, and it doesn't trickle down to investment to a certain extent. It isn't nurturing a capital market or stock exchanges in the way it happens in the United States. Now, the United States, as far as I know, is one of the countries that saves least and consumes most. But for them, equity in the markets is the key driver of investment. In Europe, it is less important than banking. So the potential that we have there is enormous. And Mario Draghi has dedicated a lot of his report also to this, saying we need 700 to 800 billion of additional money to fund investment per year, out of which 3/4 or maybe 80% needs to come from the private sector, see equity market, and 20 eventually from public sector. So mobilizing these savings is key if we want to really modernize our economy and close the investment gap and also close the competitiveness gap. In the last 10 years, the American economy grew to 30%, the European ones 15% as an average. Since the COVID, forget 21, which was a spectacular year because 20 was the year of COVID, since 2022, so in the last 3 years, Europe has grown roughly 1%. Now, you can put a smiley face on this. It is a remarkable result taking into consideration COVID, taking into consideration the war in Ukraine, the energy crisis. Yes, fair enough. But many analysts are afraid that we have a risk that this shallow growth becomes structural. One of the questions you will certainly address. And if we have little growth, we have little investment, we have less lending capacity, all this obviously is connected. And so in the blog also, we recommend having cross-border investments for the physical person, accessible for all, reduce all the burdens that exist at our borders. The free flow of capital in the European Union goes back on paper to the 60s, was then, I would say, deepened in the single market. But we have still fragmented capital markets. So that's why There's a lot of ideas out there. And as Draghi put it when he spoke to the European Parliament a couple of days ago, Mario Draghi, who I had the chance to meet also a few days ago, he said, it's time to act. And it's time to act fast. A last blog I would like to mention, which you will not find because it's not published yet. I will have a common blog with my friend Emmanuel Campa of the EBA, where we say how institutions like the EBA, the ESM, cooperate and how together they ensure more resilience for the financial sector. Now, one of the questions that people ask me on a regular basis, also my friends around me, say, Pierre, you must be now very busy. Well, I said, I've been busy since the first day I started at the ESM, or they have really no clue what we do here. And then they say to me, and how is life in Brussels? I say, so wait a minute. So I'm extremely busy, point number one. Point number two, why are you asking me how it is in Brussels? Well, I mean, the ESM, you're in Brussels. No, I say it's in Luxembourg. So my Luxembourg friends don't know that the ESM is in Luxembourg. So I have to work hard on the image, so we put new labels on the wall. But apart from that, because some of you are new here, so I highlight that. What can the ESM do in today's situation, in this extreme situation? Can you help Ukraine? Can you do something in the area of defense? So here, I'd like to spend a few minutes on this because it's a question that everybody asks, and it's a relevant one. The first one who really highlighted part of that was Enrico Letta in his report, where he said there's a lending capacity at the ESM, which is quite substantial, that could be used for countries to ramp up defense expenditures. So how much money are we talking about? We have a lending capacity as we speak of roughly 420 billion euro, which also serves another purpose, is stabilizing and safeguarding the euro area. So we cannot use the whole amount, but part of that amount could eventually be dedicated to that. Now, is this a completely new idea? It is not. In COVID times, in the night of the 9th of April 2020, when I was a Minister of Finance for Luxembourg, we decided, we agreed all together that there could be a support by the ESM using a precautionary tool, which in the end was not used and not necessary because there were so many other instruments available. But the reasoning that was used in COVID, and also the Letta report does the symmetry with this, say could be done for defense. It's a factor that comes from outside. It's hitting all the countries. And so we could have an instrument similar to the pandemic crisis support that was suggested at the time. More recently, 2 weeks ago, the European Commission, in its white paper on defense, also highlighted that the ESM could play a role. You might remember that the Commission announced the SAFE program, Security Action for Europe, which provides 150 billion in EU loans and making sure there's fiscal space at national level for that. In other words, you would not count that to trigger an excessive deficit procedure. Now, this is smart, this is fine, it's still debt, but at least you have that additional flexibility. And the Commission says now if this is not sufficient, this 150 billion, there is the ESM behind as lender of last resort. That's exactly what we are. So it's a kind of very natural thought. And so obviously we had also thought of it, but it's good that others are also thinking of it because it makes a lot of sense. It makes a lot of sense. This being said, we are an intergovernmental institution. So in order to devise such an instrument, we need to discuss that with the 20 member states and find a consensus, first and foremost. And second, we must prove that this is consistent with our mandate. Now, what is our mandate? Ensuring financial stability. Now, I think it is difficult to demonstrate or to claim that the huge amount of additional expenditures that need to be done by Europe in the field of defense, it would be really hard to claim that this has no impact on public finances. And some countries have very little room of maneuver, as we know, despite the fact that the new rules of economic governance are more flexible than the ones before, and that you have more time to adjust your expenditures in what we call the kind of medium long-term path. So we are ready to interact with the member states in the weeks and months to come to discuss that. But let's face it, we've heard a lot of announcements by individual countries who want to ramp up their defense expenditures. What I say to that, what we say as ESM, this is good. Many do say, well, we do that because the Americans ask us to do more. Every time I hear that, I say, wait a minute. The first reason why we need to do that is because it's good for our security and our defense, to defend ourselves. Knowing that our American ally has made its support less predictable, less automatic, we have to take care of our own defense needs. So that's the first reason why we need to do it. It's an obvious thing to say, but very often I hear this reversal way of addressing this question. But let's not be candid. The issue of defense and many others, deglobalization, it's not that we have unanimity in our societies. Let's face it, in the last couple of years, in many countries, if not in all of them, countries that are less enthusiastic about Europe, I can say it differently, that are nationalistic, are gaining support. So this is an internal challenge for us. And all the measures that have been announced by individual countries to increase their defense expenditures is good news. But these are individual efforts. At one point in time, we need also to find common projects to start working on a European defense, because otherwise we will not reap the necessary benefits of all these billions that we're spending. I don't know the exact number of tanks we have in Europe, so many different types of aircraft, whilst the Americans have only one. So in the end, all this is not coordinated with the command of NATO. So all these are individual expenditures which do not nurture a common approach. I'm also here not candid, I know how difficult it is. But also for us as ESM, it is important to preach that if we do more, we also need to do more together. So we haven't seen that much yet about this. There's been initiatives. The French president is very active, others too. It's also important to reach out to United Kingdom, to Norway, to different countries on this in a very pragmatic manner. And all this is easily said, but certainly not easily done. So my conclusion on this is the following. Do we really think that in these times where our reliance on the United States for our defense is less certain than it was before, in these times where a trade war is happening, do we really think that every country going it alone would be the best answer? For me, it's obvious. We need more Europe, not less. To conclude, I would like to thank all the speakers who are here, who represent. I will read the list because I was very impressed, and I would like Rolf to thank you and Amal and the whole team. We have representatives of the European Commission, European Central Bank, ESRB, European Investment Bank, IMF, OECD, Central Bank of Ireland, Bruegel, Peterson Institute, Princeton University, Bocconi, Italy, London School of Economics, SUERF, you now know exactly what it means, Amundi Investment Institute. So this is really a spectacular group. I would like to thank you really to have found a way to come to the headquarters of the ESM in Luxembourg. And I'd like to thank particularly two persons who are here today. One is Klaus Regling, who is with us since this morning and who will speak tomorrow on extreme risks of geopolitics. You know, this is his second home. He is my predecessor. He's the father of this institution. He's not Agent 007, he's Agent 001. So, Klaus, it's so nice to have you with us here. And I'd like to also greet, although she's not yet here, Elke König, with whom I worked a lot when she was the head of the Single Resolution Board. But to all of you who have found the time and made the way here, a great thank you from my side. I wish you a great conference. Thank you very much.
Thank you, Pierre. Thank you, everyone. So now I would like to invite the first panel to the podium. Before we start the panels and the presentations, let me remind you that there's massive online participation, about 300 people or so, among which journalists, and that the event is being recorded. And I don't mean to say pull your punches, but aim them well. So, Marion and colleagues, please. Thank you.
Good morning. I'm very pleased to welcome you to the first session of this conference and to welcome also our four panelists. So this morning we will focus on climate risks and how to cope with them. As Pierre already mentioned, climate risks are one of the three mega trends that Europe is facing and that Europe in the long term needs to address to enhance its economic resilience. There is now clear consensus that climate change can have a significant macroeconomic impact, both actually physical risks and transition risks. And climate-related risks also have potentially significant financial stability implications. And it's because of this link with financial stability that we at the ESM also look very closely into them. We incorporate climate change considerations into our economic risk analysis. And we also, as Pierre mentioned, look at it from a policy perspective when we review the adequacy of our toolkit. So this is an ongoing exercise, and climate change occupies a significant place in the reports that we published last year, and we are now working on the follow-up. So this morning's panel will help us deepen our understanding of climate risk, what is their economic impact, and we will also hear interesting proposals on how to deal with the insurance protection gaps that Pierre was also referring to. So we have two interesting policy proposals on that. And last but not least, we will also see how government action could be further incentivized by including it in the government issuance plans. So let me introduce the members of our panel today. First, John Hooley, who is a senior economist at the OECD, and he will present to us his study on the macroeconomic implications of extreme weather events based on regional level data for OECD countries. And this will nicely set the scene for the following presentations of the policy proposals. So we will hear a presentation from Carlos Guine on the recent ECB EIOPA proposal, which you have surely heard of. So the paper is proposing a new level arrangement for natural catastrophe risk management. So we'll hear that. And then I will give the floor to Martin Hahn from the International Association of Insurance Supervisors. He's the co-author of the proposal that Pierre was referring to for a European backstop for natural catastrophes, so co-authored with our ESM colleague Bernhard Meyer. And last but not least, we'll hear from Dirk Broders, who is a senior lead financial risk expert at the ECB, a proposal for climate-linked bonds. So we'll hear the 4 presentations, and then I will open the floor for questions, comments, so you can keep your question for the end, for the Q&A session. So, John, the floor is yours.
Thank you, Sarah. Fantastic. So thank you very much, Marion. It's a pleasure to be here today to present some joint work with Helia Costa at the OECD. I'm from the IMF, but also comment to the OECD Research Department. And estimation of the macroeconomic impacts of climate change has been an increasing focus of the work at the OECD. This is part of a broader research agenda. So there's now an emerging consensus that extreme weather events, unfortunately, have become more likely, both in frequency and severity. And by nature, these events, of course, are more difficult to predict compared to other changing weather patterns. And they're also likely to have different economic impacts. So it's important to study them separately. How should we think about their impact? Well, first and foremost, of course, they can have devastating effects on lives and livelihoods and the environment. But from an economic perspective, the overall GDP impact will depend, of course, on the relative strength of demand and supply channels. Supply effects could be negative, for example, disruption to capital labor, or positive, such as reallocation of resources to more productive uses. On the demand side, of course, negative effects could come from losses in wealth and confidence, or positive Keynesian-type effects from wealth or confidence effects, government spending or international aid transfers. And additionally, disasters in one region can have impacts that can spill over to other regions, depending on trade, migration, and transport linkages. And they can also be positive or negative. They can lead to a reallocation of production, boosting economic activity in other regions, or conversely, disruptions to supply chains and demand can negatively impact neighboring areas. And spillovers is a big impact of our empirical study. This diagram just shows an illustration of some of the hypotheses that are put forward, theoretically at least, ranging from no recovery to creative destruction. Suffice to say, empirical estimates generally find negative net impacts on GDP of natural disasters. The bulk of the literature, especially the early literature, is used on macro effects. It's based on cross-country panel studies using national level data. And generally significant negative impacts on GDP are found for developing countries with a range of estimates, 0.6 to 6% on the level of GDP. But when samples are restricted to advanced economies, however, impacts have mostly been found to be statistically insignificant, some negative, some positive. The other strand of literature focuses on effects within countries using subnational data, and a key argument for this approach is that since the effects of weather events are highly localized, it's important to study the impacts at as fine a degree of geographical aggregation as possible. These studies generally find statistically negative impacts on economic activity at the regional level. But because they focus on a single country, and typically for one type of disaster, they lack the external validity that we need to come up with more global estimates. So the approach in our paper is to combine these two strands, look at economic impacts of extreme weather events using subnational data but across a broad sample of advanced economies. And to our surprise, this approach has not been done before. So just a brief overview of the paper. Our study looks at the impact for a sample of OECD economies. We look at both the direct effects of natural disasters and the indirect effects through spatial spillovers using regional TL3 or NUTS3 level data. Our primary focus is the impact on GDP, but we also explore transition mechanisms and impacts on sectors. We also ask whether the fiscal, economic, and demographic conditions affect the costs. And finally, we examine whether the economic impacts are meaningful at the national level. So just a brief overview of the data. Our empirical analysis brings together three main pieces of information. First, climate-related natural disaster data from EM-DAT database, regional economic and demographic data from the OECD regions and cities database, and also country-level macroeconomic data. And we merge the data sets together using geolocations for EM-DAT disasters taken from a recent Nature paper and TL3 regional shapefiles for OECD countries. And the resulting data set has information for over 1,600 regions across 33 countries for the years 2000 to 2021. Similar to other papers in the literature, we focus on severe disasters with our intensity threshold, the share of population affected. We define a count variable for severe and moderate disasters, where we count disasters if the number of people affected is greater than 0.01 for moderate and 0.1% of the region's total population, respectively. This chart depicts, on the left, depicts the distribution of disasters by intensity. On the right shows the distribution of disasters over time. There does not seem to be a particular pattern during our sample period. Moving on to the empirics, we estimate the dynamic impacts of natural disasters on the economy using local projections, using a 5-year horizon. Dependent variable is the growth in the outcome variable, for example, real GDP. And the main regressor of interest, disaster, stands for the number of severe disasters in region I and country C in time T. We include both country, regional level controls, as well as region and time fixed effects. And to explore spillover effects, we include a term that captures disasters occurring in neighboring regions weighted by geographical proximity. We construct weights based on the inverse of the spherical distance between the center of each region and limit the maximum distance after which two regions no longer considered to be neighbors to 100, 200, 500 and a kilometer in turn. Now, the results suggest that severe disasters reduce real activity in affected OECD regions by up to 1.6% of GDP, with effects that are both large and relatively persistent. And the effect size depends on disaster intensity. So moderate events cause a smaller, but still significant decline of around 0.5%. And these results are robust to different clustering techniques. In particular, we also use Connolly standard errors to control for potential spatial correlation in the error terms, and 5 lags and leads of the shock variable to control for potential bias from staggered treatment. On spillovers, we find evidence of net negative spillover effects. For a severe disaster occurring within a 100-kilometer range, the impact is close to 0.2% of regional GDP. And as expected, perhaps, the impact decreases as distance from the disaster increases. In terms of transmission channels, the labor market appears to be important. Employment declines following a disaster, mirroring the overall GDP impact, though the magnitude is slightly smaller. Labor supply is also affected, as net outward migration increases sharply in the first few years after the severe disaster. In terms of economic sectors, manufacturing declines sharply, which may be expected given its relative dependence on physical capital. Construction output also declines, suggesting that any boost from reconstruction activity may be outweighed by reduced demand in a subdued post-disaster economy. Service sector output, on the other hand, remains relatively resilient, likely due to fewer fixed assets that are vulnerable to disaster-related damage. We also study how the GDP impact varies according to various initial conditions. In order to do this, we add an interaction term between the main regressor, disaster, and the characteristic of interest. The interaction term is a dummy variable, taking the value 1 when the characteristic is above the median threshold. And so we find that countries, the regions in countries with greater fiscal space, here defined as debt above or below the country's median, experience smaller impacts, likely due to greater ability to implement post-disaster fiscal stimulus. And we also find that regions with more diversified production structures, measured as a Herfindahl-Hirschman index of sectoral GVA, also face lower losses, since diversification can lower systemic risks and facilitate quicker recovery through redistribution of resources. We also look at insurance and urban characteristics, whether they make a difference. The results here are, again, intuitive. High insurance market penetration reduces disaster impacts by providing a critical financial safety net for households and businesses. And less densely populated regions face smaller economic impacts also. They may be less vulnerable to large-scale physical damage and congestion-related disruptions. And finally, our analysis finds important effects on GDP at the region level, but are these effects still important for national GDP? And we find the answer is yes. When we aggregate our results using historical disasters across OECD countries in our sample, we find severe disasters reduced annual GDP historically by an average of 0.2%. While most of this impact stems from direct effects, spillovers account for approximately 40%. And we think this really highlights the importance of including a spatial dimension when assessing economic costs of extreme weather events. Finally, there are several policy implications. First and foremost, the large potential magnitude of the impacts of extreme events, of course, underscores the need for heightened urgency in implementing climate adaptation policies. The finding that spillover impacts are important highlights the need for policy coordination across regions, but also across countries, since natural disasters can have effects beyond country borders. Coordination can take various forms, ranging from joint climate adaptation initiatives to the development of post-disaster economic recovery plans. The greater vulnerability of densely populated regions underscores the importance of resilient urban planning. The strong mitigating effect of insurance markets also re-emphasizes the need for development of these markets and increasing their availability and affordability. And finally, the key role of fiscal space highlights the importance of maintaining sound public finances as a buffer against disaster-related shocks. So thank you. I'll stop there and look forward to your comments and questions.
Thank you very much, John, for this very rich presentation and this new empirical evidence. I would pick up on what was on the last slide, which was policy recommendation on insurance availability and affordability. So I think it makes a nice transition to Carlos' presentation on the ECB EIOPA proposal.
No, indeed, it does. Very good. An excellent introduction. So first of all, thanks for having invited us to be here today, to Marion for the nice introduction. And of course, I'm Carlos Guiné. I'm heading the sustainability unit at EIOPA. And I will be presenting to you today a proposal that was developed together by EIOPA with the colleagues from the ECB. Second paper building on an initial paper on policy options that we published in 2023. And the whole idea underlying this publication and this work is really the focus on the reality that we have in terms of insurance protection gaps in Europe, and what can we do in a way to change the situation given the benefits that we see from closing that protection gap. So just to introduce briefly, what we see is that historically, looking at data since 1980, only about a quarter, so 25% of economic losses are insured in the EU. And the remaining 75% are borne either by governments, policyholders, citizens, but outside of the private insurance. We expect, in light of climate change, we expect that the severity and frequency of natural catastrophes will continue to increase, and we fear that this will lead to a widening of this protection gap, as this will create issues in terms of availability and affordability of private insurance markets. So given the economic implications also at the macro level, so not only implications for the individual insurers and citizens, but also for the macroeconomic situation and financial stability that we identify from this gap, we have started to work, and we partnered with the ECB in this project to develop policy options to see how we can support, let's say, closing, understand the causes, but also close these gaps, or narrow these gaps at least. We see, since we started this work, in Europe, the frequency and severity is increasing. We see more events. We saw Valencia recently. I mean, we see again this week, look what's happening in Greece. So the events are indeed becoming more frequent and more severe. And Europe is warming also at the fastest rate in the world. It's the continent that is suffering these impacts at a faster rate. What do we observe in practice? So on the left side, we see what I was mentioning, the frequency, the number of events, but also the volume of economic losses is increasing in Europe. We see since 1980 around 900 billion of economic losses have occurred in EU, driven by natural catastrophes. And what is maybe more concerning is that from this amount, around a fifth, 20%, occurred in the last 3 years alone. So we do see a significant increase. And then on the right-hand side, what we see is that this insurance protection gap that we estimated around 25% historically is increasing as we move forward. So the number of, let's say, policyholders abandoning the market is increasing, or the number of risks that are not covered anymore by insurance. We also observe, looking a bit more at supply also aspects, we see that this increase in the costs is driving an increase in the reinsurance price, which means reinsurance is, in a sense, the insurance for the insurers, and they will, in a sense, pass this increased cost back to the policyholder through the pricing of the contracts. And of course, this means the contracts will become more expensive and less people will be able to pay for natural catastrophe protection. On the other hand, you see some additional information confirming that from all the households that have, let's say, home insurance on the right-hand side, those that include, let's say, natural catastrophe protection, because in most EU countries this is not a mandatory insurance cover, it's optional. Those that include it are a much smaller fraction of the total, and the evolution, as I mentioned, is, let's say, not positive. And when you split it and you pin it down in low income households, you see that the decrease is affecting, the gap is evolving more rapidly in relation to these low income households, who will also tend to be, in the first instance, those more affected by climate change, because they cannot probably relocate from an area that is more prone to climate or other catastrophe risks. So, looking at these aspects, what we identify is that there are several positive effects arising from insurance. As was just mentioned by the colleague from the OECD, we do see a positive impact when there is a high penetration of insurance versus a situation when that penetration is lower in the event of a natural catastrophe. And here you see some of those effects. On the one sense, we have a faster recovery, so usually the payback from the private insurance market is quicker, settling the claims, which means there will be lower second-order losses, lower disruption arising from the event. This will also mean less burden for the fiscal budgets, because this means if there is more private insurance coverage, there is less need for the governments to step in to cover and to support the citizens. And also, of course, having an insurance usually also raises awareness to the risks, which means more better risk management that then ultimately reduces the losses. Of course, in practice, these kind of positive effects, type of externalities, are not recognized by the individual policyholders, by the individual insurers, and we dare to call this a kind of a market failure, because in a sense, the market is not recognizing these benefits, and this leads to this let's say, increase in protection gaps, because these wider societal positive effects are not really being considered by the private market. So with this in mind, we started work looking at what are the solutions that exist currently in the EU and outside of the EU. Many countries have in Europe different solutions to this issue. And also, how can we leverage learning from those experiences to a potential EU-wide approach? What our analysis has shown, very evidently, we looked at 12, let's say, national schemes, some in the EU, EEA, but also outside of the EU, in third countries. And what we see, as you can see on the right-hand side, is that when you look at the average protection gap in Europe, this is around 75%, so 25% of the economic losses are insured. But when we pin the analysis only to the countries that have national schemes in place, actually this tends to have a positive impact in terms of insurance penetration and the reduction of this insurance protection gap, meaning that the average for those countries alone increases to around 50%. So with this, we also looked at the features of these existing schemes and how those features can, let's say, inform the development of a potential European approach. We came up with an approach that is built on two pillars, as you see a bit on the picture. On the one side, a reinsurance scheme building on what we call a ladder approach, where different, let's say, players in the market all need to take part, to take a part of the losses, to ensure, avoid moral hazard, but also to ensure everyone has aligned incentives. So starting from the private policyholder to the private insurance companies, up to the reinsurance and financial markets, then to the national schemes, and on top, a potential EU reinsurance mechanism. This would be the first pillar, and then a second pillar more focused on disaster risk management that could leverage on the existing mechanisms that we already have in the EU to manage disaster risks. Both the pillars intend to build on what exists already in Europe, so it's not to replace, it's to build on the mechanisms that already exist. And the main objectives would be to bring clarity on the responsibilities, to make sure that the private sector, the public sector, have more clarity on what is their responsibility before the events, and that they are prepared to cope with that. To promote mitigation and adaptation, so both the segments would reinforce each other in a sense by promoting risk management and ex-ante investments in adaptation that could ultimately reduce the costs arising from the events. And then, of course, the ultimate goal would be to increase the private market insurance penetration, to limit public costs and reduce moral hazard that we see, of course, as very prominent nowadays. Very quickly on some of the features of the two pillars. So the first pillar would be focusing on, as I mentioned, a reinsurance scheme targeting private assets, so working together with private insurers, but also potentially with the existing national schemes. And this layer would pool the risks, let's say, at EU-wide on a voluntary basis. So the intention, as we outline it for the moment, is to be on a voluntary basis that insurance companies, reinsurers, national schemes could adhere to this scheme with a risk-based premium contribution. This would mean that there would be the right incentives in terms of aligning the premiums with the risks, promote risk management and risk reduction. And of course, by pooling at a higher level all these risks together across member states and over time, we would be able to increase the, let's say, capacity of the system as a whole, and hopefully affordability and insurability would also benefit from this. There might be a public, let's say, support to this first pillar, but it could also operate on an exclusively private basis, and it could also resort to financial markets to tap, for example, on that capacity via catastrophe bonds, for instance, to complement its funding. Then the second pillar would be more in terms of building on existing solidarity mechanisms, to create a mechanism here on a mandatory basis across the EU to maximize, let's say, the risk-sharing effects. Again, a risk-based approach, so the premiums, the contributions paid by the member states would be, let's say, take into consideration the adaptation, risk reduction and risk management efforts that are performed at the national level, for example, through national adaptation plans. And here, the aim would be to strengthen the existing mechanisms, because as we have seen recently, they have proven to be insufficient. And for example, when we had a couple of years ago the floods in Central and Eastern Europe, we saw shifts at European level of funds being made for let's say, from other purposes into, let's say, catastrophe disaster management funds. So in a sense, this money is already being invested in this type of situations. The issue is more to take a more preventive approach to try to minimize the risks by pooling this money and investing in resilience before, let's say, the catastrophes hit. Finally, some considerations. just to mention that, of course, what we have put together is a basis for discussion, is an initial proposal. And of course, we want to foster discussion among all the stakeholders, which I think we have been quite successful for the moment. There is a lot of discussions taking place at the private, public levels. Also here today, we will hopefully discuss it a bit about these proposals, about the challenges that we face. And also to make clear, as I mentioned, that this proposal does not aim to replace, to substitute what we have already in the EU and what in many cases works well, but more to complement and to strengthen an European approach. Because also this would be one of the features of this national European mechanism, is that we look at these aspects at the EU as a whole, and not sometimes we see, for example, national adaptation measures that maybe benefit the situation in one country, but then make it more complicated for the neighbor, because, for example, water will not disappear. If it doesn't go to here, it will go probably to the following member state. And of course, also to highlight that any developments, any decision to implement such mechanism would, of course, require the involvement of the member states, decision makers, but we believe the proposals could be implemented in line with the existing rules that we have in Europe. So thank you so much for your attention, and happy to take any questions at the end.
Thank you very much. So without further ado, we'll move on to the next policy proposal, which also aims at addressing the insurance protection gap. Let's just be mindful of the time so that we have enough time at the end for the Q&A session, because I'm sure there will be a lot of questions from the audience.
Okay, so thank you very much for the invitation, which I actually took a break from my paternity leave to join you here on this important topic, but I think we kind of owe it to our children to make sure that they also have a world which is worth living in. So I'm going to present you a paper that I co-wrote with Bernhard Meyer from the ESM, who unfortunately cannot be here today. My name is Martin Harm, and I'm from the International Association of Insurance Supervisors. And those of you who also follow the work of the IAIS a little bit, so the IAIS is the global standard setter for insurance supervision and does not really deal with regional solutions as the one we are proposing in this paper. So I'm not speaking here on behalf of the IAIS. And obviously, I'm not an employee of the ESM. I'm also not speaking on behalf of the ESM. That's why the slides are not branded. So adding a little bit on top of what Carlos said earlier, what we do see is that climate change-related natural catastrophes increase in frequency and intensity. And this is not going away. So even if you stop believing it, climate change, similar to gravity, it's not your decision. It's there whether you believe in it or not. There's also a recent report from the World Bank which highlights that disaster risk management relies too heavily on retention, and more needs to be done to incentivize risk transfer to the private sector, which also links to what you mentioned earlier, that when we see higher insurance penetration, the impacts of natural catastrophes are better mitigated. And also to put everything in context a little bit, so a Swiss Re study came to the conclusion that in 2023, the total economic loss was $280 billion due to natural catastrophes, of which only $108 billion were insured. And also Carlos mentioned earlier the European perspective. So if I remember correctly, on a European level, if you consider the time horizon from 1980 to 2022, average economic loss was about 15.5 billion per year. And in 2023, we saw an economic loss of around 77 billion euro. So we see this obviously strong increase in economic losses, while also seeing a decrease in insured losses. Here you can see a split due to the individual events. So hydrological events, mainly floods, are the biggest contributor to the total losses, while at the same time being also one of the least insured events. So we see that around 80% of these events are uninsured. Other events, apologies, other events like dry periods and stuff like that are not that big at the moment, but as Carlos already mentioned, Europe is the fastest warming region, so we might expect that even dry periods will become more and more important in Europe over time. So with the ongoing climate change, what we see is that many risks move from being an insurable risk, so meaning that premium can be afforded and there are insurers who are willing to underwrite this business, so there are insurers willing to insure this risk, to an uninsurable risk, meaning that either the premium is so high that it's not affordable anymore, or insurance companies withdraw completely from the market. So we do see this, for example, in California and Florida due to the most recent events. And we also see, as Carlos mentioned earlier, a steep increase in premium to insure natural catastrophes, which then also has an impact on reinsurance premium, which makes it more expensive for insurers to reinsure their business. So what we did in our paper, if you look at climate risk, it's driven by mainly three risk factors. You have the hazard, the exposure, and the vulnerability. While the hazard you address by mitigation, and exposure and vulnerability you mainly address by adapting to it. And adaptation we again split into two parts. So you have a preventive adaptation, which means making sure that if a disaster happens, that the losses are not that big. And then we also have what we call curative approach, which is meant to reduce the costs when disaster strikes. And that's the part we focused on mainly, which doesn't mean that preventive measures are less important. So an approach to dealing with climate change and an increase in natural catastrophes means addressing hazard, exposure, and vulnerability at the same time. So if we look at the total economic loss that's caused by an event, what we can do is we can split it into a part that's insured and a part that's uninsured. So we have what we call the total protection gap. This protection gap, again, can be split into something that's not insurable or uninsurable and an insurable gap. And what we focus on is the insurable gap because that's the part we want to close, and that's what we see is big and even growing due to an increase in natural catastrophes. So how does the risk-sharing process work? So what we typically have is that a part of the loss is covered by the insured, so that's the deductible. Then the primary insurer comes into place and covers for the losses. The primary insurer to keep its losses within limits then reinsures its business, so the higher parts are then captured by the reinsurer, and when the reinsurance contract is exhausted, typically the primary insurer has to capture the risks again and pay for the losses up to a specific limit. And everything beyond that is the insurance gap, which, as I described earlier, can be split in a part that's an available capacity and a part that's not insurable, simply because the risks are too frequent there or catastrophes lead to too big losses. When we speak of this available capacity, we have a part that's supply-driven, so that's driven by insurers not providing insurance cover because there are too big risks, there is too high volatility for the insurer to offer these contracts. And we also have a demand capacity that simply because cover would be available, but market participants do not go for this cover. As Carlos also mentioned earlier, this could be due to not having sufficient awareness of the risk, or also because policyholders do think that if disaster strikes, the government will bail them out. And we have seen this in the past, that quite often, if a very big disaster strikes, the government will step in, cover for the losses, and there is this kind of expectation by the public that governments will step in. And the governments, as we all know, there is always a next election coming, so there is a kind of incentive to make sure that the losses are covered. So our proposal now is to add an additional layer after the reinsurer come into play. So the idea is to have an insurance pool to which risk-based premia are paid, and this insurance pool can then benefit from an increased diversification because it would pool risks from all over Europe, which has the big advantage, for example, for smaller insurers, which are quite often are only exposed to one specific natural catastrophe, be it flood or be it dry period or whatsoever, and they have more or less no possibility to diversify their risks because they are only regionally active. And having this access to an insurance pool which allows them to diversify across regions and across risks would help them to increase their overall insurance capacity. On top of that, to make sure that there is an additional mechanism if the insurance pool is exhausted by its premium, there is this backstop solution which can provide a loan to this insurance pool so that claims can be settled quickly to avoid also a potential liquidity strains on the insurance market. The idea of this insurance pool is, of this backstop solution, is that it's fiscal neutral over the medium term, so that this loan is provided by an institution that can refinance itself at very cheap costs at the capital markets. And this would lead to the situation that because of an increased diversification and because of cheaper refinancing, that insurers are able to close the insurance gap because the available capacity will be made available to this backstop solution. An alternative approach, instead of providing a loan, could be issuing catastrophe bonds, where the backstop is the single investor in this catastrophe bond. What we also did is we ran some simulations to compare the efficiency of such a backstop loan solution compared to raising the money on the capital market. So what we did, we compared the net present costs for the insurers using the loan approach and using financing themselves on the capital market by simulating their cost of capital. And we did see that in many situations, due to the cheap refinancing costs of these institutions, this loan-based backstop facility is superior than refinancing on the capital markets. Okay, thank you.
Thank you very much. So I'll hand over directly to Dirk for his proposal for climate-linked bonds.
Thank you. Thank you for being on the program this morning. And this is an idea that I would like to tell you about. And while we're waiting for the slides, I can mention that indeed I work at the ECB as a risk manager, but I'm also affiliated to, as you can see now, Maastricht University as a professor of finance. And these are my own views, so also no branded slides. So, as a sort of an introduction to set the stage, I don't have to explain to you climate change is urgent and, even more important, potentially irreversible. And there is, of course, political delay now, but I think it's also good to mention that there's no trade-off between transition risk and physical risks. So any delay in mitigation will increase both transition risk and also physical risks. And obviously the best approach to combat climate change is to internalize greenhouse gas emissions. But what I would like to explain to you is that there is a potential additional instrument that governments and supranational organizations can use as a policy tool to signal commitment and also to align incentives. And I will try to explain to you what I mean by that. So what are climate-linked bonds? So these are debt instruments, of course, of which the payoff is adjusted over time based on realized climate-related metrics. So it's very similar to an inflation-linked bond, but you replace CPI with another metric, for instance, the average land temperature or greenhouse gas concentration levels in the atmosphere or water levels. This obviously provides a government with funding, but it will also attract climate-conscious hedgers in the market. So, because we're facing a market incompleteness, it was really clear from the other presentations, so there is insufficient availability of instruments that you can use to hedge climate risks. Next to insurance, there are several ideas in academic papers for dynamic hedging strategies that use the asset price responses to climate-related news. You can see several references here. Obviously, these dynamic strategies involve transactions costs, and they also are imperfect hedges. While the idea of a climate-linked bond, it features an adjustment mechanism that allows for more direct risk hedging. Now, what is the main economic idea here at play? So there will be issuers of these bonds. You can think of agents in the economy that are not exposed to climate change or less exposed to climate change, and that are willing to sell the bonds at a certain premium to agents in the economy that are exposed to, more directly exposed to climate change. So you can think of a market where in equilibrium, these agents agree on the quantity and the price of the climate-linked bonds. Now, they could trade directly This might be difficult to organize in practice, but you can also have the trading going on via the government's balance sheet. So the government would facilitate the risk sharing. And I think it's also good to mention already now that this is different from a catastrophe bond for several reasons. So in the case of a climate-linked bond, the protection is for the investor, not for the issuer of the bond. And the protection runs via the link of the payments on the bond to a climate-related variable. And the coupons adjust, or the payments adjust over time in discrete steps. And is temperature evolves over time without being related to one specific trigger. So the economic idea is that you benefit from that not all agents in the economy are equally exposed to climate change. So how does it fit into the universe of other related bonds? So there are, of course, green bonds that are, the proceeds are used to invest in green projects. I guess this is similar for climate-linked bonds, although it's not necessarily, so it can also be used for general financing. Green bonds typically have regular coupons, either fixed or floating. There are also sustainability-linked bonds, where the payoff is linked to self-imposed targets. So the nice thing about climate-linked bonds is that they can be linked to objective measures, and also, for instance, not influenced by political choice. And catastrophe bonds I already mentioned. So we claim in the paper that climate-linked bonds reduce three gaps in the economy. So first of all, the information gap. So if there is a liquid market for these bonds for different maturities, we have a forward-looking market assessment of the expectation of climate variables, but also for the climate risk premium. This enhances transparency. There's an incentive gap. So what is the incentive of a four-year government to take climate mitigating actions, which is a long-term process? So by issuing these bonds, governments sort of commit themselves for a longer term to impose climate policies. And there is the insurance gap that we already discussed this morning. So also the bonds help a little bit in reducing the climate insurance gap. So what are the benefits for the different stakeholders here at play? So governments, so they align their financial obligations with climate action, because it's very simple. The instrument is very simple. They pay less on the bonds if they are more successful in for instance, lowering average temperature. And they also get the benefits of that because the investors in the bonds are willing to pay a premium for that. As I already mentioned, so the advantage for investors is that it provides an instrument to hedge long-term climate risks. So, and it offers also diversification benefits in the portfolio. And for the economy in general, so the price discovery process being facilitated by the climate-linked bonds is a really nice instrument to have forward-looking indicators of climate risks. Now, if I could move to the next slide, which I don't know by heart. It doesn't seem to work at this stage. Here we are. So in the paper we have an asset pricing model for the bonds. I won't bother you with that too much this morning, but I will give you the general flavor. We model an economy with exposed agents who will have a demand for the bonds, and unexposed agents that supply the bonds. We have some climate dynamics where we look at climate or temperature anomalies, so how the temperature going forward deviates from a certain reference period. And we have damages, so these are a function also of the change in temperature. And there are two investment options. So we have regular risk-free bonds that offer a fixed return. And we have the risky climate bonds that offer a return which is a function of the temperature anomaly. And we simply maximize utility or final wealth by taking into account climate damages that are incurred by the exposed agents. So in equilibrium and market clearing, under market clearing conditions, so the investment demand for the bonds is driven by the level of risk aversion, but also by the Sharpe ratio of the climate bonds. But next to the investment demand, there's also a hedging demand, which is mainly driven by the sensitivity of the bond payoff to temperature change, and indirectly then also to climate damage. Obviously, in market equilibrium, the net supply of the bonds is zero. And then we derive, in a very simple setting, the equilibrium bond price, which is the present discounted value of the expected payoff of the bond. But more importantly, also there is a climate risk premium that is a function of risk aversion, the fraction of agents in the economy that is exposed, and the correlation between the bonds and the damages in the economy. I think this is a rather intuitive solution. So the other thing that we do in the paper is we make it concrete by estimating how much of these climate bonds should be issued by different governments. So we assume that some proportion of the outstanding nominal bonds will be replaced by climate-linked bonds. And for that, we look at going forward, long term, 75 years, what the expected increase will be in temperature, and how much of the damages that will be caused by that will be absorbed by the government anyway. So the government, as was mentioned in the previous presentation, is sort of the residual insurer. So we make here very explicit that the government has a role to play in absorbing these damages. And then we can derive via this function that you see how much bonds should be issued. So we did this for the major economies in the world. You see in this chart, in the blue bars, how much the temperature is expected to increase going forward. For instance, for Canada, it will be 3 degrees Celsius. And for the Netherlands, who has already experienced quite an increase, it will be something like 1.5 degrees going forward. And the orange dots indicate the fraction of the outstanding bonds that should be replaced by climate-linked bonds. So something like 2 to 5% in the expected scenario. If the government would be a bit more precautionary, these numbers could be twice or even 3 times higher if they want to anticipate, let's say, a more extreme scenario. I think these numbers are very, very similar to the fraction of inflation-linked bonds that are out there. Okay, is this easy? Is this going to be easy? I don't know. Maybe also for you to judge. I think there are a lot of challenges, of course, with this instrument. It's well known from the literature that government debt can be used to constrain future governments. There is an important question of free riding. A small country who thinks that it will not have a lot of influence in reducing temperature might free ride on larger countries issuing these bonds. And also, of course, there's a long transmission lag between climate policy and the effects of that. We believe there are also many counter-arguments. You see 4 here on the slides. This could be a first step to form climate clubs, which were proposed by Nordhaus already some time ago. I think, there is this incentive, so for governments to issue the bonds because they benefit from the greenium, but they also control what they pay on the bonds going forward. And there is this immediate feedback from market pricing and market discovery on the perceived credibility and commitment of government policy going forward. So let me end there. Just to recap the key message that climate-linked bonds could help to prepare for extreme events in several ways. So it will incentivize governments to take action, and we can use the current pause in policy action to design all the instruments that we are discussing this morning. For investors, it offers an opportunity to hedge long-term climate risks and also to reduce the insurance gap. And I think that's the cool feature. The price discovery process will allow us to derive, very similar to inflation-linked bonds and other inflation-linked instruments, to have a forward-looking expectation of climate risks and also the climate risk premium. Thank you.
Thank you very much for this very interesting presentation. So now we have about 20 minutes for the Q&A session. I would like actually to kick it off with a question of mine on your paper, Dirk. So you say, rightfully so, that one of the objectives of the proposal is to create the right incentives for governments. And for that, I think the choice of the climate metrics or climate variable is very important. Here you choose increase in temperature, but especially for small countries, there is indeed only partial control of the government over it. So I was wondering if you've looked into other variables which are maybe more policy-based, based on the actual policies of the government, so to have a stronger influence on the incentives and of the government. So I'm thinking, for example, on the climate change performance index, which looks into, which is a mix of actual outcomes, but also policies. And then I will collect questions from the audience.
Thank you. Very good question. There are obviously also large countries that could issue these and have a more direct impact on these climate variables. And I think it's open for design. So if the wish of a country is to have more influence or direct influence on an indicator, that obviously is possible. We discuss 3 of them in the paper, so not only temperature, but also average greenhouse gas concentration levels and also water levels. And I think it's up for discussion. I think there's a lot of benefit if we sort of coordinate or could coordinate globally, that we use similar metrics, that we have standardization, and that will contribute to a liquid market. And obviously, I think then temperature is maybe one of the obvious candidates. But it's a trade-off. If we think that a country should have more influence on a specific variable, that I think is also well possible in our design. Thank you.
Thank you. So any question, Rolf? Okay. Okay, Lucio first and then Rolf. Sorry.
Thank you. I would have two questions. One concerned is, I would say, the second and the third paper, because both seem to imply, in my view, some kind of public backstop at the top of the system. And in one case, actually, it was said that the mechanism that is envisaged would be compatible with the EU treaty. So my specific question, whether to which extent this has been verified. So what would be the treaty basis for that? Because this has implication for the decision-making mechanism. But this actually links to my main question, which is, take the case of Italy and Sweden, just to a random couple of countries. I happen to be married to a Swede. What would be the interest of the Swedish to enter this type of arrangement? In other words, there is not an element of solidarity, which is quite strong, but maybe in short supply. And the second question is about the last presentation, linked to the previous question, in fact. And it's about mitigation versus adaptation. Because ideally, this bond should be issued globally. The one linked to as the question put it. by contrast, adaptation is very much in the hands of the government. So if you link something like catastrophe bond or perhaps another variant, there would be an incentive for the government, to engage in adaptation and reduce the damage that a variable that cannot really be controlled except at the global level has it. So whether you thought about this dimension. Thank you.
So first of all, great presentations and thanks a lot for this. My question for the first part to Carlos, also to your paper, and in a similar vein as what Lucio said. You said the European insurance-based arrangement would be voluntary, and you think this would work, that this is incentive compatible. And I wonder whether you did the computations in terms of pricing, or what is the driving mechanism that there is, that in that regard, no moral hazard, or that it really pays out, and to which extent you also think about regulatory incentives and changing in regulation of getting there. I mean, if I think about the alternative proposal, or the one that is put forward by Martin and Bernhard, which is a bit more also leaning towards the arrangements we have in the banking sector. In the banking sector, the backstop, the single resolution fund is obligatory. There's obligatory membership, right? So, and that makes a difference for how it works economically. And then also a question to Dirk. We have seen the German government has actually ended the inflation linkers. Because it's relatively expensive to have linked bonds, it's a niche market, and you said in your computations this would be also a niche market. So my question is, to which extent you have actually also considered those issues of the additional liquidity, premium or lack of liquidity that this would have to provide? What does it mean for pricing? And the other point is related to what also Marion asked. What do you actually measure, and how do you measure it? We know that getting the GDP linkers off the ground is terribly complex, also because of the measurability problem. So to which extent that actually may put a boundary of what you can do with those bonds?
Okay, so Carlos, maybe first.
No, thank you for the questions. Maybe starting from the first, in terms of the let's say the system, how it could work, what could be the interest. I mean, first, in terms of the alignment with the treaties, I mean, as I mentioned in my presentation, what you have in our paper for the moment is still a relatively high level with principles designed. If such proposal would, let's say, go forward, it would need, of course, more drill down in terms of the concrete implementation of it. Because, as we said in the paper, we do not envisage at this moment, or at least this is what the paper, what we say for the moment, is that it should build on what exists. We know that, sorry, what exists is different from country to country. And of course, this also creates challenges to such European layer, how you then interact with, in some cases, member states where there is mandatory protection for this type of risks, with other member states where this is not the case. Depending how you in practice then implement it, and why this is why we advocate it should be on a voluntary and risk-based approach, you may indeed create some sort of transfers between the countries. That's why for us, for the first pillar, we argue it should be more market-based. So the objective of the first pillar is really to lower the costs of private insurance coverage. And there you could have a backstop, a guarantee by public money. You see that this is very often a feature in many of the existing national schemes, which very often comes associated with mandatory take-up of the protection. So, At the moment, we are not being, let's say, we are not specifying it should be one way or the other. I think then as we move forward and if there is indeed support to consider in more detail, and we continue working on the topic to try to, for example, quantify how big could such system need to be? What kind of amounts are we talking about? So to put a bit more also some technical analysis behind it, then we will need to take certain decisions and on how it's implemented in practice. On the second pillar there, we argue that indeed there would be an interest by every member state, because today we know the catastrophe exposures are different. The hazards, the perils are also different from member state to member state. But there you have, as you have already today in the existing mechanisms, a certain degree of let's say, of support between the different member states, that the catastrophes will not hit every time, every country at the same intensity, at the same moment. But when they do, such mechanisms facilitate then the response that can be put together. And then maybe coming to the second question on the, let's say, on the first pillar being completely voluntary, if I understood how have we did, let's say, a bit the computation, how this can help in terms of the moral hazard. And this is why we set it as a ladder, with, let's say, making sure that every step of this ladder has a part in the total losses that arise from the catastrophes. Also the clarification element that it would bring. What we see today is that, of course, there is significant, I think some of the other presenters mentioned it, there is a significant reliance on government intervention, that if catastrophes come, you see the government stepping in, and this has a negative effect of even further amplifying the gap. And I speak my home country, this happened recently in 2017. You had some big fires. I'm Portuguese, by the way, and there you see that as the government steps in to support, those that have insurance before, in a sense, have an incentive to not continue having it going forward. So the idea of the mechanism that we propose there is really to make sure that every intervenient bears a certain part of the losses, and also, of course, referring to what I was mentioning before, we would also need to consider carefully in the design how we interplay between different member states where there are certain different regimes in place. Because what you also need to try to avoid to some extent is that this framework is only picking, let's say, the worst risks of the whole pool, in a sense. But I mean, these are initial considerations that, as I mentioned, if we would evolve over the next months and years to a more concrete implementation, we would need to drill more into the specifics of the implementation in practice. Thank you.
Martin, very briefly.
Yeah, so the idea of, sorry for bringing this terrible cold to Brussels. So yes, the idea would be more to go into the direction of a mandatory participation, which then, of course, you have the optimal diversification you can obtain. But we also mention in the paper that this has to go. So first of all, that the premium payments to the insurance pool are risk-based. So meaning that if you're exposed to a lower risk, then the premium you are going to pay are also lower. And it also has to go in hand with additional adaptation, so that it can't be that there is a country that says, okay, we have this insurance pool now, and this insurance pool will cover for all the damages, and we will reduce our efforts on adaptation, which, by the way, would also increase your risk premium for this insurance.
Dirk, maybe a few words on Rolf's question?
Yeah, thank you. Very good questions. I think ideally, of course, this is something you want to organize globally. And this can be done. There is also a Paris Agreement. I think it's good to also mention that it makes the implicit role of governments very explicit. So it's also something that the governments then can manage. In terms of standardization, I think that would be really great to have a liquid market. I think climate scientists and finance experts should sit together to think of indicators that are objectively measurable. And one thing, so we have a few charts in the paper on how the average temperature changes over time. That's much less volatile than inflation. So I think these can be designed in such a way that it provides the right incentive, it provides some hedging opportunities, but also that it will not burden too much the payments done by the government. So the fiscal burden can also be managed. Thank you.
Let's take one or two more questions before we break for lunch. So I think there was a question over there. Yeah.
Yeah, my question is to the last presenter again about the climate-linked bonds, about their global aspects. Climate is a global public good. So without cooperation, there is no way to tackle this internationally. So releasing unilateral bonds would be a remedy for those.
I'm not sure if I understood you correctly. You said at the end a remedy for this?
Yeah, for example, for commitment to climate tackling policies, right, you said. So it needs to be done by multiple countries, but if a country just supplies climate-linked bonds by itself, it wouldn't signal that it can do much.
It wouldn't signal that it can do much.
by the country itself, right?
Yeah. No, indeed. So I think we need leadership. I think if this is a good idea, also for the other ideas, there should be countries or groups of countries stepping up and saying we're going to do this because we think this brings benefits. And I think the first step is always the difficult one. But since we are in Luxembourg, maybe Luxembourg wants to look into this. I saw it also appear on one of the charts this morning. So could be, although I think they have a very small outstanding debt here. Yeah. But I think it can help. Good point.
Okay, I think we'll close on this note. So thanks a lot to the four panelists for the very interesting presentations and for the questions. I think we touched upon a couple of important questions. What should be the role of the public versus private sector, and then also the EU versus national level. So I think the papers showed that there is a case actually for EU level intervention because of the externalities, risk diversification, also the additional resources that can be mobilized. And the question is about how to design such a scheme. I hope these papers provided good food for thought. And with that, I invite you to go for lunch. The next session will start at 1:15. Thank you.